Hello. Welcome to chapter 15. So last chapter we talked about accounting. This chapter we're going to talk about a similar topic, financial management. The learning objectives for this chapter explain the role and responsibilities of financial managers, outline the financial planning process, and explain the three key budgets in the financial plan. Explain why firms need operating funds, identify and describe different sources of short-term and long-term financing. So finance activities include preparing budgets, doing cash flow analyses, and planning for expenditures. And personally, I did all of those things in my career over 25 years. Financial management is the job of managing a firm's resources to meet its goals and objectives. A big part of that is the planning for it, planning for meeting the financial goals. Financial managers examine financial data and recommend strategies for improving financial performance. And this is typically what I explain to people is the difference between a bookkeeper and an accountant. The accountants are the financial managers. They give the recommendations for improving processes and improving the profitability of the company. Tasks include obtaining funds and effectively controlling the use of funds. So we're talking about budgeting. Who's who? I've been CFO. There's the Chief Financial Officer. There's the Certified Financial Planner. There's the Certified or Chartered rather Financial Analyst. And then there's the Controller or Comptroller, the Chief Accounting Officer. I've been both a CFO and a controller in my positions. These positions here, typically in a larger company, bigger corporations. So here's what financial managers do. They do internal audits. They manage the taxes to reduce the taxable income. They advise top management on financial matters. So how do we do things better? How are we going to increase the bottom line? They do collections of cash. They control funds. They obtain funds, so they sell bonds. They work with the banks to get credit lines, that sort of things. Big things, planning and budgeting. Most common reasons a firm fails financially: undercapitalized, meaning not enough cash, poor control over cash flow, and inadequate expense control. I can tell you from my experience, I worked for a company that signed a big contract with Disney in December, and they got $1 million up front on their contract. Well, they were so excited that they spent most of that $1 million on year-end bonuses, parties, that sort of thing. The problem was when we got into the project, and I was hired in January, when we got into the project by May, June, we had no cash left to fund the rest of the project. So we had to start borrowing money. Financial planning involves analyzing short-term and long-term money flows to and from the company. 3 key steps. Forecasting the firm's short-term and long-term financial needs. This goes in many cases to what's called a projected cash flow. So I would do a cash flow projection for 4 to 5 weeks at a time. So what I did was I estimated how much money was going to be collected in a week, how much we were going to have to pay out, and if there was a shortfall. Developing budgets to meet those needs. Establishing financial controls to see if the company is achieving its goals. And achieving goals typically means, are we meeting the budget that we set for the year? The short-term forecast predicts revenues, costs, and expenses for a period of 1 year or less. The cash flow forecast predicts cash inflows and outflows in future periods based on sales and revenues. I typically use the accounts receivable aging report to do that. The long-term forecast predicts revenues, costs, and expenses for a period longer than 1 year. So that's more capital budgeting, that kind of thing. The budget sets forth management's expectations and allocates the use of specific resources throughout the firm. So what a budget does really is it projects how much revenue is the company going to get, what are going to be the expenses associated to creating that revenue, and is there going to be anything left? Budgets depend on the balance sheet, the income statement, obviously the statement of cash flows, and then short-term and long-term forecasting. The budget is the guide for financial operations. Is the firm meeting its short-term financial commitments? So are they paying their bills on time? Is the firm producing adequate operating profits on its assets? Well, you can look at the statement of cash flows for that. If there's more cash coming from borrowing than from operating activities, you have a problem. How is the firm financing its assets? And that's what we just talked about. And are the firm's owners receiving an acceptable return on their investment? These are all things that the financial manager needs to be able to answer. Key needs for operational funds: managing day-by-day needs of the business, controlling credit operations, acquiring needed inventory. If you're a merchandising company, maybe a retail operation, you have to be continually buying inventory in order to have something to sell. That requires cash. And making capital expenditures. Now, in a factory, in a manufacturing company, the capital expenditures are key because you're constantly, over time, replacing equipment. Alternative sources of funds. So a firm can raise needed capital by borrowing, selling ownership, which is equity, or earning profits. Those are the three places. So we're talking about debt financing, which is borrowing, equity financing, which is typically selling stock, and then other short-term and long-term financing options. Trade credit is the most widely used source of short-term funding. Essentially, in business, you get 30 days to pay the bills of your vendors. So Office Depot or Staples delivers the office supplies. You get 30 days from that invoice date to pay the bill. Now, they may, in order to encourage you to pay early, they may give you special terms like 210. 210 means that if you pay the invoice within 10 days of the invoice date, they reduce the invoice by 2%. One thing you can never have too much of is cash, right? Cash pays the bills. Financial managers must make certain there is enough cash available to meet daily financial needs and still have funds to invest in its future. What does it mean when we say cash has a time value? Well, the value of the dollar next year is going to be less than a dollar this year. Many small firms obtain short-term financing from friends and family. That's a tough thing, but if you do it, make sure you get it in writing. If asking for help from family or friends, it's important. Agree to terms, everything in writing, and arrange for repayment the same way you would for a bank loan. So keep it very professional on a business basis. Commercial banks generally prefer to lend short-term money to larger, more established businesses. During difficult economic times, bank loans can virtually disappear. And we're coming up to a recession, which is going to be difficult for small businesses to get additional financing. A secured loan is backed by collateral, a tangible item of value. So when you get a car loan, for instance, the car loan is backed by the value of the car. If you don't make your payments, what do? The bank comes and takes your car. Same thing with a mortgage loan. If you have a mortgage on a house and you stop making your mortgage payments, the bank comes and takes the house. Line of credit. A line of credit is usually based on a percentage of accounts receivable. And it's an amount of money the bank puts aside and says you can borrow up to this maximum. But the nice thing about the credit line is you don't have to take the whole thing. You take what you need and you pay interest on only what you take. Factoring is the process of selling accounts receivable for cash. Factoring is a big deal in the garment industry because the garment industry typically needs a lot of money up front to make the clothing that they're going to put out for the next season. So they're working 4, 5, 6 months ahead. Credit cards, bad way for a company to finance. Estimated that 1/3 of all small firms use credit cards to finance their businesses. Credit cards are convenient, as we all know, because we all use them, but risky and very, very costly in terms of borrowing. If you've gotten any credit card offers recently, personal credit cards are running starting at 14% interest. The 5 C's of credit: character of the borrower, the borrower's capacity to repay the loan, the capital being invested in the business by the borrower. So what are they doing with the money? The conditions of the economy and the firm's industry. Is the company going to come into a difficult period where sales might drop? Obviously, if sales drop, you may not get your loan payments. And finally, the value of the collateral the borrower puts up to secure the loan. Bonds are another way that companies can finance. Bonds are simply a document that says the bondholder has given X amount of dollars to the company. The company will hold that money for X amount of time, paying interest every 6 months or every year. And then at the end of the term of that bond, the principal gets paid back. And that's it for financing. Thanks again for joining me, and let me know if you got any questions. We're coming up towards the end of the semester.